I found that nothing in life is worthwhile unless you take risks. Nothing. Nelson Mandela said, "There is no passion to be found playing small and settling for a life that's less than the one you're capable of living."
Hey traders, today we'll talk about how to day trade for a living using a trading plan. How to use a trading plan to actually make money that you can depend on to bring back home and spend it on your family. Let's talk first about what is day trading fans. Day trading fans is a day trading club. It's a community. It's a social club. It's actually dedicated to connecting day traders together worldwide, all over from the US to India to Africa to Europe to Asia. Our club offers a few things, a few benefits to every trader. And here are the things. Number one, it offers a membership, a lifetime membership that is for free, that gives you unlimited access to all services offered by the club itself. And it gives you that sense of community. You're not just joining us just to learn one strategy that will make you millions of dollars that you tried before and never worked. You're not taking a class and just going away. You are part of the community. You're dealing with us every single day. And when you're dealing with other traders, we don't try to isolate you from other traders just like any other mentors do. Second thing is we offer comprehensive training programs that are actually tailored to every trader's experience and goal. This is a key. Every trader is different. Every experience is different. Every psychological makeup of every trader is different. So just to give you one strategy that will make you millions because it worked for me is never going to work. I'm sure you have fallen for this one before, and I hope you don't fall for it anymore. Every person is different, therefore every trading plan is different. We just help you to build up your own trading plan and therefore achieve consistency in your profitability. The third thing is we offer mentorship. We don't want to give you a trading plan. We can and we will actually offer you a PDF at the end of that video and give you that trading plan. But the intent is to show you what a trading plan looks like. We want you to build your own trading plan. What stocks are you trading? What options are you trading? What crypto are you trading? What is your risk tolerance? What is your profit objectives? All of this stuff we're going to teach you how to build it based on your account size, your market, your risk tolerance, your goals. All of this is different between each one, but we'll help you get yours done. Number 4, we offer performance evaluation of every trader, which means, let's say you just took your trades today and it didn't work out for you, or maybe it did. But you want to know what you did right and what you did wrong. And sometimes you can't really do that yourself. You need another set of eyes to tell you, here is what went wrong. And our mentors and our traders will offer you that for free. Most of the times it will be for free, unless you want the one-on-one kind of mentorship. And that's when you probably have to compensate the mentor for his time. Number 5 is we fund traders. Look, we offer you something that is guaranteed to make money. And therefore, we offer you our capital to trade. Which means that when you start making money, we will make money too. We'll split out the profits in a certain percentage. We can talk about that later in the funded program and how we can fund you and we both make money. But we wouldn't risk our money if what we're telling you is not guaranteed to work. What we want to make sure is you do the things that you actually said you're going to do. Look, 99% of the traders know what to do. They just having a hard time doing what they know they're supposed to do. But with that mentorship and external guidance, we definitely can help you do what you're supposed to do, or at least hold you accountable. This way you can hear it from somebody else saying, here's what you did wrong, and therefore we can move on. The 6th thing is help you become a licensed proprietor trader. In the US, if you want to use leverage more than 4 to 1, we can get you leverage up to 100 to 1. but you have to be a license in the United States. So for every dollar you have in your account, you can trade up to $100. So let's just say your account right now is $10,000. That means we can give you up to $1 million buying power. So your profits is amplified. But on the other side of the coin, your losses would be amplified too. So we want to make sure you are on the right side of the market. That leverage is just going to help you make a lot more money a lot faster if you know what to do. And our job is to make you to get you there. Before we dive into the trading plan, I want to provide you with our links to become a member of our community. These are the links to Day Trading Fans. The website is www.daytradingfans.com. We have the YouTube channel, Day Trading Fans. And the best thing about our community is we have apps on Google, Android devices, as well as Apple devices. If you scan the codes on the left side or the right side, based on what device you're actually using, you're going to download our app, and therefore you can communicate with us a lot faster, and you also can communicate with other traders. Check on other traders, see what kind of trades they are into. Are they forex, crypto, stocks, options? You're going to meet all kind of people there, and you can create your own chat group to communicate directly with them. Kind of similar to Facebook group, but the difference is Facebook groups and Facebook chats are full of scams. Our job here on our app to make sure none of these scams, the account managers are taking over, all this stuff. Once we see something like that, we'll block it completely. You are not being scammed on our app. I promise you that. And if you see any activities that doesn't make sense to you, please report it to us, and we'll definitely make sure that this particular person or entity is off our app. We also offer Udemy classes. Here's the link. If you have any questions, any particular questions, please email us at daytradingfans@gmail.com, and you will receive an answer within the first 24 hours. The most important thing is to differentiate between what's a trading plan is and what's a trading strategy. I cannot believe how many people come to us don't understand the basic difference between a trading plan and a trading strategy. A trading plan is a detailed set of rules that governs every move on your trade. It's an overall plan. The military call it campaign plan. It actually turns your trade into a business. You're not going to go into a business without having a business plan. Where are you going to get your stuff from? Where are you going to buy it? Who's going to, where are you going to buy it from? Who are you going to sell it to? How much a profit margin in every item? What's the risk? What's the expenses? That's a business plan. A trading plan does the same exact thing to you. It shows you how much risk and how much profit you're getting. Does this trade make sense to even get into the trade, or just feelings, emotions? It's your body telling you. Trading plan will tell you straight up in your face, this is gonna risk that much money to make that much profits. So, trading plan is a detailed set of rules governing every aspect of how you trade the market. It outlines every trade like a business plan, making the trader consistent in his trading execution and resulting in a consistent profitability while limiting the risk. Trading strategy, on the other side, is only part of a trading plan. Trading strategy only considers the entry and exit criteria. These are merely elements of a trading plan, and traders include more than one trading strategy within an overall trading plan. So where is it most traders, most beginners make a huge mistake by buying all these strategies? Your Facebook is probably flooded with ads about this strategy is going to make you $1 million. You're going to turn $800 into $1 million in 3 days, or all these scams. That's one strategy. A strategy is never going to work unless you have a plan, because what happens is it's going to show you where you enter based on moving average and this and that, all of these things that you've been trying, but it doesn't show you the whole picture. It doesn't tell you what to do next. And a trading plan is going to tell you what to do next and will help you build your own trading plan. Trading plan includes a few elements. So if you look on the right hand side right here, that's a trading plan. If you look at it, we actually have a PDF format of this one. If you need us, please email us daytradingfans@gmail.com and we'll send you a copy of that. And the beauty of this particular plan is actually fillable. So as you're trading, you can actually write, your trade execution things, and we're going to show you how to do that. This way, you actually, log your trade as you go. You don't have to wait at the end of the day. It might go right, it might go wrong. You actually walk it step by step, just like anything else. So a trading plan is a detailed set of rules governing every aspect of how you trade the market. It includes 4 things. The trade parameters right here. Trade parameters is on this side right here on the PDF format. A trade parameters forces you to define your risk, like Mark Douglas says. You have to define your risk. How much are you willing to risk per this trade? And once you put that into the PDF format, how much are you willing to risk per share? And it's going to automatically calculate the number of shares that you cannot exceed for your position. That's number 1. Number 2 is Trade Triggers Playbook. What are you trading? Is it a single bar strategy? Is it a multi-bar strategy, which is right here? Those 2. What are you trading? You have to define, you have to put a name to what are you trading. What made you get into that trade? It's not, Apple is coming out with a new iPhone, so I want to jump in before everybody else. That's not a trading plan. So this particular trading plan is going to force you to define what strategy are you using. And as you go with these strategies, you can actually mark it either with your handwriting or a PDF format where you type it on your computer. You mark, you went into a bullish trigger bar. Or no, you're using a pattern. You're not using a single bar. You're only using a pattern. And a pattern will be considered, for example, tweezers bottoms. This way you want to, use a pattern instead of a single bar. Just to give you a quick differentiation between single bar strategy and a trading plan strategy, a multi-bar pattern strategy. A single bar is usually during the open of the market between 9:30 and 10:15. This is the time where the market is still pricing the stock, still going up and down in a way that unpredictable. So the single bar strategy is best for the first 30 to 45 minutes of the market. A pattern strategy is pretty much between 10:15 and 3:30. This time people are more looking at patterns. The market's already been priced, unless there is a significant news like a Fed Reserve announcement or something like that. Under normal market condition, people will follow the patterns, and therefore it's best for you to follow the patterns as well, because the market have memory. All right. The third part of the trading plan is entry strategy. You decided what you're going to trade. You know how much you're going to risk per trade. You know how much you're going to risk per share. You know how many shares maximum for your trade. How you're going to enter and how you're going to build up that trading position, your position. So right here on the PDF, you're going to see: are you going long or short? Are you going with the trend, counter trend? Are you? What's your risk? What's your initial risk? Now, if see, big if here. If the trade is going in your direction, you are entitled to use a build-up strategy. You're not gonna add to a losing trade. If the trade is not going in your direction, you're gonna skip that part. But if the trade is going in your direction, that means you're on the right side of the market, and you can build up your strategy build up your position using the build-up strategy. And we can talk about that later on. Okay? The fourth and most important part that most people fail to execute is exit strategy. Right here. Exit strategy. How are you going to exit your position? Doesn't matter if it's using the 1 minute, the 5 minute, the daily, the monthly. Doesn't matter what time frame you're using. How you're going to enter that position. You're not going to be in it for until you retire. And even if you do an IRA account and 401k and all this stuff, you still have to have a parameter to exit that trade to limit your losses and maximize your profits. In this particular plan, there's about 9 of them or 8 of them. And stop loss, of course, is always here. Okay? At the end of the day, at the end of the trade, their PDF format is going to actually automatically calculate how much you made and how much you lost on that last section right here. And it's going to show you, it's going to scream at your face, this is your trade performance. This is how you did today. That's why a trading plan is very important to actually execute the trade to perfection. So to summarize the importance of a trading plan. You see the trading plan on your right hand side right here. It's a written trading plan. It's a PDF format. It shows you what you need to do and when you need to do it. It turns your trading into real business. It provides clear entry and exit strategies, no emotions, straight up business. It prepares you mentally and it takes emotion out of the trade. You know you are willing to risk that much money, so therefore you are accepting that before you even get into the trade, and this is the most important part of trading. Builds up your trading discipline. I cannot tell you, most of the people that actually losing money day after day after day are because of the lack of discipline. Trading plan is going to build up that discipline because it's going to show you everything before you even get into the trade. It highlights areas where you need improvement. That's not the trade improvement. That's you, the trader. Where do you need improvement in executing the trading plan? If you move the stop loss, it's going to show you right. It's going to scream at your face. You did something wrong. If it comes to like 2-to-1 profit objective, like here, right here, and you didn't book that profit because you think it's going to go to the moon, and it turns against you and it goes, whoosh, it dumps. It's going to scream at your face. You were able to book profit and you did not. So a trading plan is going to show you that. It forces you to identify how much risk you are willing to take and how much profit potential before you even open your position. How much risk and how much profit. These are the keywords. What if the trade does not have, yes, you feel like something is going to happen, it's going to go up, but you see the trading plan is going to show you a huge resistance on the top of that trade. Would you still take it? And if you take it, I can guarantee you the trading plan is going to show you that you went against, it's going to be a counter trend. And therefore, it was your own fault, your own mistake. All of this stuff, the trading plan, at the end of the day, is going to scream at you where you made mistakes and how you're going to fix it. Therefore, the next trade, hopefully you are disciplined enough to just take one mistake out of that and execute the trading plan again. And execute the trading plan again until you become, it comes down to like the process of elimination, where you eliminate one mistake after another. And hopefully after a certain amount of time, you will be able to execute that trading plan without any emotions and without any mistakes. Let's get into the real business of a trading plan. First thing we're going to talk about is the candlesticks. Candlesticks is the alphabet of the chart. I can't believe how many traders trade without looking at the chart. Somehow, they figure out there's an opportunity there without looking at how did the stock do in the past. And at least, even if you're not a technical trader, you can at least look at the chart to actually confirm your bias about where the market is going and what you're hearing in the news. Candlesticks lead and light the way to profitability. That's exactly what happens. Candlesticks will show you the way to profitability. Mark Douglas is one of the best trading coaches that ever existed. We lost him big time when he passed away a few years ago. Mark Douglas says no man ever reached to excellence in any part or any art or profession without having passed through the slow and painful process of study and preparation. Studying the chart is going to actually make you achieve excellence. After a few losses, the wins will come. What are candlesticks? Candlesticks is the history of the candlesticks goes back to like the 18th century in Japan. That's why they call them Japanese candlesticks. I guess an investor called Huma was a Japanese businessman, and he invented this technical tool right here that you see right there to gauge the potential price of rice before entering into a contract to buy or sell rice. He discovered that the rice market sentiment changes according to supply and demand, and every time it changes, he put it on a candlestick. He invented that graph to show where is the sentiment, and based on the sentiment, he would actually either get into the contract or not. This method now is pretty much widely used in stock trading. It predicts market sentiment. It does not predict future movement. It just gives you the market sentiment and possible price changes of the stock. There's a huge difference. There's nothing in the market, nothing on the chart. Nobody knows where the market is going to go next. But based on where the price have been, you can at least make an educated decision to enter or exit that trade based on the memory of the market. Just like we said, the market have memory. How does the price form the candlestick is a very important part of how to read the chart. Each candlestick represents like a battle fought between the bulls and the bears, the buyers and the sellers. At the end of the time frame, let's just say we always use a 5-minute time frame in all of our trades for daily trading. Every 5 minutes, where did that bar start, where did it end, is going to actually decide, is it bullish or is it bearish, right? When the candlestick closes above the open, the bulls win, producing the green bar or bullish bar, which means the market is bullish. The sentiment is bullish. When the market closes below the open, the bears win, producing the red bar or the bearish bar, which is this one right here. As it goes down, the sentiment is going down. Every candlestick shows you if the market is bullish or bearish, and therefore you can actually decide, are you going with the market, are you going against the market, or you're staying neutral like here. Once the candlestick finalized, once the 5 minutes have passed, this is how it's going to look on your chart. It's going to have an open price. This is a bullish, of course, bar. This is going to be your open price, which is below. It's going to go up, down, up, down, up, down, up, down until it closes at the price at the close. On the opposite, the bearish one is going to start high and it's going to go low. So you have the open price, you have the close price, but in the same time, as the bar is going up and down, this is going to go to the highest part of the candle. This is going to go to the lowest part of the candle. The wick, this is what we call it, the wick. The wick is still part of the price of the candle. It's very important. A lot of people dismiss the wick or the tail. This is a big mistake that most traders do. The wick is still part of the bar. So on that green side, if the bar is green on your chart, of course, the bulls win the battle and the stock is trending up. On the other side, the bear win the battle if the bar is red, and you could say the sentiment is bearish market for that particular time frame. For that particular time frame. Do not try to jump between time frames. I've seen people have 12 different charts. I've seen people having the 2-minute chart, the 5-minute chart, the 15-minute chart, the hourly, the daily, the weekly, the monthly. I have even seen mentors teaching people that they should have so many different charts, at least 6 charts in the front of them to confirm. They call it like different time frames in alignment. And this is the biggest mistake they have ever done, because when one chart is trending up, the other chart is trending down. When one time frame says buy, the other time frame is saying sell. It's going to confuse you, it's going to make you hesitant, and it's not going to work out. Choose the time frame and construct your trading plan based on what that time frame is. If you say, I'm going to put my stop below the trigger bar in a bullish trend, that's where you keep it. If you look at the 15 minutes and the 15 minutes says sell, now you have a problem. So you need to keep one chart. The most effective, the most reliable time frame for day trading is the 5-minute chart. If your mentor's telling you trade the 1 minute or the 2 minute, he is entertaining you, because he's going to keep you busy fighting bar after bar. It's all noises. It's the 1 minute and the 2 minute and the tick chart are all noise. Things like the 15-minute and the hourly work, but the risk might be too large for your risk tolerance. You may not want to lose $5 per share. You may want to just risk $1 per share. So the 15 minutes might be too big for you. So, but if you can stomach that kind of risk, you can go to the 15 minutes and the hourly. The higher the time frame, the more significant the move. The higher time frame, the more reliable the move. Which means, it's better to go to a higher time frame, but at some point, the risk is not going to be too large for risk tolerance. For day trading, a 5-minute bar presents a perfect risk to reward ratio within 1 day. Okay, we spoke about the alphabet of the market is the candlesticks. There is only 13 candlesticks that ever exist on the chart. For this particular session, we're going to talk about just 2 of them. Okay? The most bullish and the most bearish candlesticks. What you see here, are these 2 right there. What you see here, we're going to talk in other videos. If you follow us and join our community, we're going to show you how to use this one, for example, to either short or go up. What's the difference between a long wick bar and a shakeout bar? Some people call it long tail bar. Every candlestick shows you an opportunity to either buy or sell, and we can work you up all of these to use these candlesticks. But for this particular video, not to make it too long, we're going to just talk about the most bullish right here and the most bearish right there. The wider the distance between the open and close, the greater win or loss. The bigger that particular bullish bar, the higher the sentiment. People are buying. There's a lot more demand than supply. The longer the bearish candle right here, the higher the supply than the demand, and therefore the market sentiment is bearish. Trigger bar strategy is the number 1 strategy that every beginning trader should master, should excel at for using it before anything else he can do. If he cannot do this simple strategy, he is not going to be successful using patterns. Patterns, they use too much information. This makes trading very, very simple. When the demand hits, you buy. When the supply is higher than the demand, you sell. Trigger bar is going to show you that, and we're going to show you on the chart how it works out. When the bar is big, as you can see this one right here, comparing to the recent bars on the chart, it's called a trigger bar. That's because it triggered the move. It triggers something. Trigger bar reflects the execution of a large order and have a higher probability of follow through in the same direction of the bar. You see here the market is going pretty much sideways, maybe even downtrending. And then suddenly a hedge fund or whatever happens decides he wants to get in on that particular stock. I believe that was a Tesla stock. So he decided he wants to invest in Tesla. And when these guys move money, they move a lot of money. So what happens is when he puts in an order, he doesn't put 100 shares or 500 shares in. That's going to be easily absorbed by the market. He puts a 1 million shares that he wants to buy, and he wants to buy right now. And what happens is the chart shoots right up. Then after what happens, it becomes pebble in a pond effect, which means everybody's going to notice that bar. Whoever notices first gets in on it first, and he's going to go on the same side of the market. So you start seeing this. And then you might go like that, and then the technical traders are going to start buying. It's going to start buying, it's going to start buying, it's going to start buying, it's going to start buying until the move is over. So you have to, as you look at the bar, especially on your cell phone, there's no excuse right now. You can do it in your cell phone. You don't have to have two different screens and computer, and all of this stuff. On your cell phone, the charts are very, very advanced. As soon as you see that humongous bar is formed, you know there's a lot more demand, and therefore you want to get in on that action. The question is where you buy. Where you buy in that bar. Has this bar been confirmed as a bullish bar, or it could be just whoosh, starts coming down? We're going to show you where to buy. The bullish trigger bar strategy tells you not to buy the same bar. The trigger bar only reflects the execution of a large buy order and have a higher probability of a follow through, which is uptrend. So as you see, what happens is that's a trigger bar right there. This particular, here's another chart. This stock is LCID. It's a 5-minute candlesticks. It was going in like very, very, very narrow range, very, very flat, and suddenly out of nowhere that bar comes shooting through the chart. Where to buy is the question, and we'll show you that. Bearish trigger bar. Here's another example of a trigger bar on the opposite side of the market. Bearish. This particular, it's the same stock, LCID, or I think it's Lucid. And the chart is kind of, you see the candlesticks are very, very, very flat. And suddenly, huge bar shows up out of nowhere. And bam, the market fell through. Everything he realizes there's a huge supply. Somebody's dumping shares into the market. Probably an insider, probably a hedge fund, probably a bank, saying that we're no longer interested in Lucid, and therefore they dump their shares. It creates a panic in the market, and everybody has shares. They dump it. Everybody that doesn't have shares, they short that particular stock, and therefore creating a downtrend. So a bearish trigger reflects the execution of a large sell order and have a higher probability of a follow-through decline, of that particular stock. It's very important to differentiate between a bullish trigger bar and exhaustion bar. There's a huge difference between a trigger bar and exhaustion bar. Both of them are large bars. Both of these bars are large bars. The trigger bar happens next to a consolidating period and starts the trend. You see here a very, very flat area, and suddenly this bar starts shooting up and down, showing you there is something going on in the market, and it ends up being a green bar, therefore it's a bullish trigger bar. However, if a huge bar shows up at the end of the trend, that's an exhaustion bar. Exhaustion bar shows that this is the last kind of, demand. Whoever is moving the market at this time, whatever hedge fund, whatever banks is buying into this stock, is actually decided to finalize the purchase. This was the last purchase, and therefore the market exhausted. The run. The run is already been exhausted. That's where the names come from, exhaustion bar. So it's very important to determine the difference between exhaustion bar and trigger bar. Do not buy a huge bar at the end of the trend. It's gonna be a huge loss, because what happens is most of the times after exhaustion bar, the market pulls back at least 50%. At least 50%. So trigger bar happens next to a consolidating period and starts the trend. Exhaustion bar on the other side happens after a long run and ends the trend. These are this is a huge point that you have to realize. Here's another example of a bearish trigger bar versus a bearish exhaustion bar. A trigger bar happens after a flat period. It starts the trend downward, starts a decline. Exhaustion bar on the other side, it's already ran for so long, right? It ran for about half an hour, and that particular bar is an exhaustion bar. Just wanted to show you an example of a bearish versus bullish exhaustion bar. If you ever join us, if you ever join our community, we're going to show you some videos as well. We're going to even work with you one-on-one, how to identify single bar strategies, how to buy the green reversal bar or the hammer bar or the inverted hammer bar, how to buy the whole number, when and why. On the other side, if you're a sophisticated trader and you're getting the bullish side, you're getting the buy side good, we're going to teach you the shortened side, because the shortened side is very important, especially in today's market. It's a very bearish market. Therefore, pretty much 70% of your profits are going to come from shortening the market, but you have to understand how to use shortened strategies, how to sell a red reversal bar, how to sell a shooting star, how to sell a hanging man bar, how to sell the whole number, when, where, and why to use the whole number as a natural support and resistance is very important. On your trading plan is going to show it to you just like that. And as you execute your plan, you look at your particular trade, and you're going to say, all right, I'm going to buy the green reversal bar, and you're going to mark that. That's the second step of your trading plan. You're going to mark, doesn't matter if you're going to use that automated PDF format or you're going to print it out and just hand jam it. You're going to write, I bought the green reversal bar. Therefore, after a day, after a week, after a month, when you're reviewing your trades for that particular week, you know what went right, what went wrong, and therefore you can adjust your trading plan from there. Okay, the second most important thing on your trading plan is to use patterns. Patterns. That's because patterns, like we said, after a market pricing period of between 9:30 and 10 to 10:15, the market have already priced where that stock is going to be for that day. Therefore, the pattern is very important thing to actually realize, to recognize and to use it to your advantage. Patterns are the graphical presentation of price movement. Graphical presentation of price movement. It will show you where people bought and where people sold. Why people are buying it here, why people are selling it there is none of our business. But there is a natural support and resistance area that you can use to profit from. Therefore, patterns are very important things. Let's talk about what Mark Douglas says. If you ask me to distill trading down to its simplest form, I would say that it is a pattern recognition numbers game. We use market analysis to identify patterns define the risk, and determine when to take profits. That's Mark Douglas quote. If you don't know Mark Douglas, please join our YouTube channel at Day Trading Fans on YouTube, and there's a library of his videos. Mark Douglas is a trading coach that he was one of the greatest trading coaches that ever lived on this planet, and he turned people around huge. He turned me around, made me from consistent loser to consistent winner just by listening to his videos. For this particular part of the video, we'll talk about the support and resistance. We talk about it because it's very, very simple for those who are new to trading, but there's a lot more patterns that we can discuss on this particular trading plan that we're going to send you in an email. I think there's about 9 different trading plans, 9 different patterns that you can profit from. But to make this short and to show how you utilize your trading plan, we're going to use the easy support and resistance trading strategy. Support is the price level at which demand is strong enough to prevent the price from further decline. Every time it comes down, people jump in, they say, all right, the stock is cheap, let's buy in. Resistance on the other side is the price level at which selling is strong enough to prevent the price from rising further. Comes to this, and nobody wants to bid the market up. Everybody wants to sell. The sellers are a lot more than the buyer, therefore they bring the price down. Let's see that particular chart. It goes here, comes down, doesn't really go to support, comes up, back up, doesn't really come to resistance, but it shoots down and bam, bounces right back up, and bam, bounces right back up. Doesn't reach support. It reaches support a lot, quicker. It stays in the trading range, comes here and bam, shoots back up. Trading range, comes to the support level, shoots back up. It hits the resistance level, shoots back down, all the way down to support, and it continues to do that in a trading range. Now there is other trading strategies where you can actually use the breakout. So let's say it breaks out, when to buy is the question. If it breaks down, when to sell or when to short is the question. We're going to show you that in a different, if you ever join us. Trading range. We just spoke about the support and resistance, and you can see it on that particular chart. This particular stock in a trading range for a certain period of time. Okay, trading range plays an important role in determining whether support and resistance functions as turning points or continuation pattern, which means every time it hits support and resistance, that pattern is still valid, until it comes to a point where it breaks out. Now, when do you buy that? There is a way to buy that. If that breakout is confirmed and continues to shoot back up, you buy right here. But what happens if it shoots back down? There's probably a market manipulation. Somebody wanted to create the false breakout to bring buyers in and dump his shares. And it happens all the time, no issues. So he created a false breakout and then shoots right down and bam, he's dumping his shares at a higher price. Because if he dumps his shares anywhere here or here or here, he's going to create this. So he has to break through that particular resistance level. He brings buyers. He sells right here at a higher price before he dumps his shares. And once he dumps his shares, everybody else does. And bam, it goes all the way down. So it's very important to recognize when the support and resistance work and when it breaks. If it breaks, be very careful. It could provide you with a nice breakout buy opportunity. It could provide you with a short opportunity. It depends on what happens to the price after the breakthrough happens. Okay, support and resistance. Where do you enter? Is the question. Support levels present a buy opportunity or entry point. This is very simple. We're not going to spend too much time. You already established this is your support level, this is your resistance level. You put your orders to buy right here and to sell right there. So if it hits, you don't even have to watch the chart anymore. If you establish this is your support and resistance, and you're a hard-working man on your 9 to 5 job, but you still want to profit from the stock market, you just create, okay, I'm gonna buy at 9 and I'm gonna sell at 10. Every time it hits 9, I'm gonna buy 100 shares. Every time it goes to 10, I'm gonna sell 100 shares. And therefore, you can automate your buy and sell orders in a way that you can be away from the chart and still make money. Now, it's very important for this, if you're not going to watch the chart, or even if you're watching the chart, is to establish what? What are you going to establish? Stop loss order. You have to define your risk as according to your plan. So if it hits, if it breaks out, if it goes here and does not bounce back and it boom, it dumps, then you didn't lose much. You probably lost 10 cents, but if it shoots back up to 10, you made $1 per share. Therefore, your reward to risk is 10 to 1. That's how you make money in the market. Here's another example of a support and resistance pattern. Shows you where the resistance level presents you as sell opportunity or exit point. You sell here. What else you could do? You can short right here. And then what do? You put your stop loss. This way, if you short here and the market doesn't do this, the market goes like that, boom, you lose very little money. But if the market goes down and you buy here, you're making a lot more than you're losing. Predefining your risk, putting a stop loss in the market. I cannot tell you how much resistance people have against that. People do not want to put a stop loss. People put a stop loss and they move it. People put a stop loss and they completely remove it. People just, don't want to admit they were wrong, and they think the pattern betrayed them. The market betrayed them. It's not them. It's the market that actually caused them to lose. It's not the market. It's the trader. Okay, when you join us, we're going to teach you other pattern strategies. How to buy resistance breakout. How to buy a climactic decline. How to buy double bottom. How to buy inverted head and shoulders. And when to buy it. How to buy tweezers bottom. I love tweezers bottom. I make most of my profits from tweezers bottoms. Amazing pattern. Amazing. And instead of giving you a 1 trigger bar, it gives you 2 trigger bars. It confirms the pattern, confirms the move. There's no better way than the tweezers bottoms, in my opinion. Rising 21 moving average. Now, I can tell you a lot of people online, they are teaching the moving averages. The problem is they're teaching the moving average as a real, it is a strategy, but they teach them as if the moving average, if the stock comes down to the moving average, the stock is going to bounce right off of the moving average and goes back up. That is not true. If you ever took a course or you have a mentor, he tells you the price is going to bounce off the moving average, you're being deceived. Because what happens is that moving average is a lagging moving average. It follows the price move. That moving average is right there because the price put it there, not because the price did not bounce on the moving average. The moving average caught up with the price. We're going to teach you how to use the rising moving average or the declining moving average in the right way, without putting so much emphasis on it on a way that will make you lose money. I can tell you when I started, I took one of these classes that all they taught is nothing but a simple moving average. And I realized everybody's teaching it, so it reinforced my perception that the price will react to the moving average. and it took me, I can tell you, probably $750,000 of losses to realize there is a time and place to use the moving average, and it's not for a beginner trader. That moving average is more of somebody that already been trading the market for a long time, already knows what to do, already understand that moving average is a lagging indicator, and knows how to manage the risk. Does it work? Yes. Does it work for beginning traders? No, it will not. It will make you lose money. I promise you that. And if you ever been losing your money due to the moving average, please share your story with us, because we would love to actually use somebody's real story to show if they made money or lost money, and show other traders the proper way of doing it. Okay, other pattern strategies is the sell strategies, or the short strategies. How to short the support breakdown, how to short the rally, the climatic rally, how to sell or short the double top, the head and shoulders, how to short the tweezers tops, how to use the decline 21 moving average to benefit from the market. Again, this is more of an advanced indicator. This you have to be very careful with if you are very new to the trading career. Your trading plan is going to show to you like this, just like that, on a PDF format. You're going to mark, you actually bought the support level, you bought the tweezers bottom, you sold the climatic rally. Whatever your trade is going, however you done it, you need to mark it. This way you log in your trade. It does not just give you a trading plan, it gives you a trading checklist. It gives you a trading log. You can print that out, or you can use your handwritten one and keep it in a folder. At the end of the week, doesn't matter if you're winning or losing, you need to come back to it and look at it and see what worked for you every time and what didn't work for you every time, and then you can adjust your trading plan, and we can help you do that. Now it's time to talk about entry strategies. How to enter the market. You already identified your edge, or your trade, or your trigger. How to enter that trade, and how to execute and manage that trade. Let's talk about another quote of Mark Douglas. When you really believe that trading is simply a probabilities game, concepts like right or wrong, or win or lose, no longer have the same significance. Mark Douglas is saying here is, doesn't matter what you do. Let's say you identified the pattern or the trigger and you got in, and the trader ended up being a loss. It's not a loss. It's just a trade that didn't work. And if you keep doing it, if you keep using the same edge, eventually you're gonna win. As long as you keep your losses way below your wins, you're gonna win. Assuming that you're gonna lose, for every share you're gonna risk $1, but you're gonna make 2. You lose 1, you make 3. You lose 1, you make 4. You lose 1, you make 10. You lose 1, you make 20. At the end of the week, or at the end of the month, you're gonna be making money. Let me give you an example. A restaurant that sells sandwiches might have a lot of losses. Food might be spoiled. So there are losses, but at the end of the week and at the end of the month, overall, they are making money, because not every single loss is bigger than the wins. Their wins are always bigger. Okay, we're going to talk about the trigger bar entry strategy, the simplest and most beautiful one for beginning trader. If you're a beginning trader, I want you to master this one, and I promise you, this will take you, this alone can create money for you that will make you, the kind of money that you can bring home and spend on your family. Let's talk about this particular stock. I think this stock is Tesla. Okay? This particular trader identified a bullish trigger bar, which is right here. This one right there. He identified a trigger bar. Therefore, he decided to open a long position at 142 and 10 cents. Now let's talk about it. He saw the trigger bar going up, down, up, down, up, down, up, down, and ended up right here. Okay? Once that bar is finalized, ended up being a green bar. Okay, so he's going with the market. He's not going counter market. He's going with the market. He's going long at the second bar. As soon as the second bar starts forming, he's buying right there. Okay, at $142.10. His initial stop, he had to define his initial stop for every which is below the trigger bar. He bought here. He decided to put his stop loss right there, which is $1 per share. He put it there because this is a trigger bar. The trigger bar started dancing up, down, up, down, up, down, up, down, up, down, but stopped at $141.10 or 11 cents, right? And he decided to put that immediately below that support level, which is the trigger bar support level. So he bought at $142. He put his stop loss $1 below his purchase price, which is $141.10. Let's see how many shares he bought. Now, trading plan is going to show him that. And let me show you the beauty of this particular trading plan. That trader is going to go to his trading plan. Now he is willing to risk $500 per trade. Right? Here it is, $500 per trade. He goes into his trading plan, his PDF format, and he puts $500. He put his stop loss $1 below, which is below the day, like based on the graphs. The chart says, okay, we're going to put it below the trigger bar, and this is $1. $1 risk per share, so he puts $1. And his overall risk, he's now willing to lose more than $500 according to his trading parameter, his risk tolerance, and his trading plan. The trading plan automatically is going to calculate that. It's going to divide $500 over 1, and it's going to give him 500 shares maximum position size. Maximum position size. So his max position size will be 500 shares. Now, if he was only willing to risk, if he was willing to risk $2, that would be only $250 shares. And if he was willing to risk $5, his position will be only 100 shares. That trading plan is going to tell you how heavy you are going into the trade automatically. If you need a copy of that PDF format, please email us at daytradingfans@gmail.com and we'll send you a copy for free. So that trader does exactly what he does. He buys 500 shares of Tesla at $142.10. His risk is $1 per share. His overall risk or total risk is $500. Now he went long with the market. He went with the trend, and his stop loss is $141.10, which is $1 per share. All right. So on the chart, his risk is still the same thing. He buys 500 shares right here, and let's see what he does. This is a copy of his trading plan, by the way, guys. If you ever need that, please let me know. The trader went into the trade. Now he owns 500 shares of Tesla. How does he exit? How does he book his profits? What does he do after that? Which is chapter 4 of our trading plan. And like I said, the trading plan is a lot bigger than this video. We're just giving you one example. If you need to build up your playbook and design your trading plan, please email us and we'll help you out build your own trading plan. Mark Douglas says, putting on a winning trade or even a series of winning trades requires absolutely no skill. On the other hand, creating a consistent results and being able to keep what you created does require a skill. Making money consistently is byproduct of acquiring mastering mental skills. Trading plan is your guide, is your GPS, your navigation system to acquire that mastering mental skills. I would say after a year, or a few months or a month, if you know how to execute that for a month, you don't even need to keep that trading plan in front of you anymore. You can just trade automatically and you still make money because the trading plan is no longer on paper, it's on your mind. So that trader decided to use a very simple exit strategy. He looked at his trading plan right here, and his profit objectives starts with 1-to-1 reward to risk ratio, 2-to-1, 3-to-1 daily target, whole number, exit, high and low of the day, which is just like here, prior resistance and support, which is also right here, and reversal bars. So he has 1, 2, 3, 4, 5, 6, 7, 8 different ways to book his profits. Let's see which one he wins. He decided to go first with the reward to risk ratio, and he decided to go with the 1-to-1 first. He risked $1 per share. He took his 500 shares and he decided to split them into five lots. Every 100 shares is going to exit 100, 100, 100, 100, as you see right here. Okay. He bought at $142 and his maximum risk per trade is $1. So he put a sell, the first sell order, he put it at $143.10. And bam, the market went in his direction and he scored $100 profit. Now he sold 100 shares, he only 400 shares. He still have 400 shares and his stop loss at the same part. But here's the beauty of the trading plan. Why, I got asked all the time before, why would I sell 1-to-1 reward to risk ratio? Shouldn't it be at least 2-to-1 so I can make money consistently? That's a great idea. In the beginning, as a beginning trader, the 1-to-1 does two things for you. It validates that the trade is working and you're on the right side of the market. That's number one. Number two, it actually reduces your total risk. And let me show you how. It reduces, like in case the market goes up in your direction 1-to-1 and suddenly comes down, your risk is a lot less. Validates means that if you, after 20 trades, if you are not hitting the 1-to-1 consistently, you have problem with your strategy. You're buying at the wrong time. You're selling at the wrong time. The 1-to-1 should tell you, listen, your batting average, which is how many times you're right versus how many times you're wrong, is more than 50%, and you need to make it more than 50%. So out of 20 shares, out of 20 trades, if you don't get at least 10 1-to-1 reward to risk ratio profits, you have to look at your strategies. You have to look at your entry points. There's something wrong there. And that's why the trading plan, as we said, it actually shows you what's wrong with your trading. If you don't hit the 1-to-1 consistently, something wrong with your trading strategy. The second thing it does for a new trader, a 1-to-1 reduces the risk and makes it a lot less, the trade is a lot less risky, and I'll show you how he eliminated the risk completely. So he sold 100 shares at the 1-to-1 reward to risk ratio. He made $100 profit. Now his risk, if the market comes to here and it tanks, is gonna only be $300 loss. No longer, it used to be $500. It's no longer $500 now. It's $300. It reduced his risk by $200, not just $100. Why? Because you only have 400 shares left, $1 per share, and now his total risk is $400, but he already booked $100 profit, making his total risk only $300. That's the beauty of that. The stop loss still at $141.10, but he's only risking $300 $300 for total risk for this trade. And that's the beauty of a trading plan, and that's the beauty of the 1-to-1 reward to risk ratio. Second profit objective, can you guess that one? He did exactly, he's using his trading plan as he's supposed to, and bam, he puts a second set of sell order at $144. Every time the price goes up $1, he's booking a 100 share, he's selling 100 shares. That second share is a 2-to-1 reward to risk ratio. He sold 100 shares, he made another 200 shares, $200 profit. Now his trade performance up to now is positive $300. It's automatically calculated on your PDF sheet. Let me know if you need a copy. So now he has 300 shares left. He already sold 2. He's got 300 shares left. His stop loss is still at the same spot, but look at the beauty of this. It came down to 0. He's no longer risking any of his money, and he's still in the trade with 300 shares. Why? Because his first trade was $100 shares, $100 profits. Second profit is $200. Now $300 risk minus $300 profit. His risk is 0. This became a riskless trade. He can do whatever he wants from here. He's not losing money, even though he did not move his stop. If there's anything that I would actually recommend to this trader is to move his stop to ensure that he's making money. But he decided to stick to it and just go with it and manually book his profits. So the 2-to-1 eliminated the risk of that trade for the remaining of the 300 shares that he's still holding. Third profit objective is the 3-to-1. The 3-to-1 reward to risk ratio. He sold another 100 shares, making another $300 with a total profit of $600. Let's see what he did. He still has 200 shares right here. He created his sell order at $145. So he bought at 142, 500 shares. He sold the first 100 share at 143, second 100 shares at 143, third is at 145 and 10 cents. Every time the stock moves $1, he is taking a slice of his position and making more money. So the third exit was 3-to-1, 100 shares. He scored a 300 shares because it's a move from 142 all the way to 145. So that's a $300 profit per 100 shares, and brought his total profit into $600. His risk per trade is definitely 0. He's not losing money at all. He's going home with money regardless. Even if it goes right here and it comes all the way down, he's still making money. All he's got left is 100 and 200 shares. And if he loses 200 shares, if he loses $1 per share, he is losing $200. So $600 minus 200. He is going home at this point with 400 if the market completely tanked and he did nothing. He's going home with $400 profit. Beautiful, beautiful. He continues. This trader is just, let me tell you something. This trader is a pizza delivery guy. He's one of the best trading students that we ever had. He continues to book profits at 4-to-1. He created another order of 100 shares to sell 100 shares at $146. This particular order gave him, which is his daily target. His daily target, by the way, was 4-to-1 reward to risk, and he hit it. So he sold 100 shares at $400, and the PDF format automatically calculated he's already have $1,000 profit. Now what's his risk? His risk is 0. Even if it tanks, all he's got left is 100 shares. Now he's got $1,000 profit minus $100 loss. If it goes like this and he does nothing about it, he is still making money. He's going home with 900. Absolutely beautiful trade, absolutely great trader. His stop loss is still at 141. Now, if he ever checked with us, I would actually ask him to move this his stop loss from here to maybe here to maybe here. It depends on how far he went. He shouldn't have moved his loss, but he is a new beginning trader. He did not want to, complicate his trade, and he kept it as is. And no, of course, he is entitled to that. So his 4-to-1 risk reward ratio is considered a great trade, but most trading mentors will tell you that if you can score 4-to-1 reward to risk ratio, you are a great trader. Now notice this. We spoke about the exhaustion bar. As you see here, that was his trigger bar, right? And that was next to the flat area, and that triggered the entire move. Now what happens here? What do you think happens here? Huge bar after a long run. That's a 2-leg run. See that? That's a pause. So that's a 2-leg run right there. That's an exhaustion bar. The vast majority of times when a huge exhaustion bar form like that at the end of the run, that trade might pull back. It may not, reverse, but it's definitely due for a pullback. There's so much demand that's happening that it might trigger a pullback. People are getting worried about what happens next. Let's see what happens. All right, now the trader only have 100 shares left, and as you can see, the exhaustion bar ended the trend. So he only have 100 shares left. He looks at it. He's still waiting for another $1. He's looking for another $1 profit, but he did not get it. What happened after that? He got one red bar, as you can see here, and then followed by a second red bar, as you can see here. So what he did is, as soon as the red bar got confirmed, he sold right there. So he sold that reversal bar. Reversal bar, which is the red, took out the green. And then after that, it got confirmed with another red. That's the reversal bar got confirmed with the second red bar. So the trader did exactly what his trading plan asked him to do. There's a reversal bar exit. He took that. He sold his 100 shares, scored another 365. He was hoping to get $500. He did not get it, but he still was able to book $365 from his last 100 shares. The PDF trading plan automatically brings his profit to $1,365 profit. And pretty much that ends his trade. So the reversal bar confirmed by a second red bar, and the trader sold his last 100 shares as per his trading plan, bringing that particular trade to a beautiful, profitable trade. If he lost money, it would be very little money. After the first, look what he did here. After the first 100 shares, he reduced his risk from 500 to 300. After selling his 200 shares, he completely eliminated the risk of that particular trade. After the third 100 shares sell order, he's already deep in profit, and he hit his daily target after the fourth 100 shares, the fourth slice, and the fifth slice he took of the position was a reversal bar. He still did not lose money, even though the market went against him at that last 100 shares. He still booked $365 per 100 shares. Day trading fans will work directly with you, one-on-one, to make you design and build your own trading plan. Like we said, we're gonna send you, if you need our version of the trading plan, the PDF, the automatic PDF that actually shows you when to get in and when to get out, please email daytradingfans@gmail.com, and we'll send you a copy of that. But if you are trading something else, if you're a forex trader, if you're an options trader has completely got different plan. We have it for you. We'll send it to you. if you're a crypto trader, if you're Forex, if you trade something else, if you have different parameters of the trade, if you have different strategies, we need to put names to these strategies. We need to build it. And we can help you, work with you one-on-one. We can virtually hold your hand and build your trading plan. And we've been doing it so many times, so many people. And this particular plan is actually costs you $999. You're gonna get one-on-one mentorship. You're gonna get hands-on training to build your own trading plan. You're gonna get hands-on training to we're gonna do some trade reviews to identify problem areas, and we're gonna adjust it after we see what worked for you, what didn't work for you. We're gonna adjust it. Certain strategies may not gonna work for you. If you have a problem executing a simple moving average, maybe we're gonna take that out. Maybe we're gonna keep you with the single bar strategies. Maybe a single bar you're the kind of guy that's looking for confirmation, so the pattern will work for you. We're gonna actually gauge where you at in your trading career, and are you a full-time employee? Do you trade off your cell phone, or you trade off a screen? Do you have time between 9:30 and 4 o'clock, or you don't have time? There's a lot of things goes into trading, and a lot of people are just like copycats. They are not really identifying the differences. What works for me may never work for you. What works for you may never work for another student. But we're gonna tell you, we're gonna help you actually create that particular plan. It's at $999, but for this particular holiday season, we're offering a 70% discount. 70% discount is gonna go from $999 down to $299. Okay? You can scan the barcode. It's gonna take you straight to the website. It's gonna show you the payment form. Please go to apply or add a coupon and write 70. The coupon is called 70. That's a coupon. You write 70 is gonna drop your plan from $999 all the way down to $299. You can also download it, or you can actually purchase it off our app. If you have not downloaded our app, please download our app. You can go to your phone and search for Day Trading Fans on your Apple phone or Android phone, or we're gonna give you a scan right now, a QR code. You can scan it and you can download the app as well. Here's what I'm gonna do for you. I'm gonna give it to you after you purchase it. I'm gonna give it to you for free. I'm gonna give it to you for free in 3 cases. If we work with you to build your own trading plan and it doesn't work for you, after 3 months, if you show me that you did everything we asked you to do and it's still not working for you, I'm gonna refund every penny of your money back to you after 3 months. But you have to show me, you have to document that. You have to show me you did that and it did not work. I can guarantee you that once we see where the problem is, we can fix it. If you're not hitting 1-to-1 reward to risk ratio so many times, and every time you get in, you're the kind of trader, every time you get in, it dumps. Every time you get in, it dumps. There's something wrong with the strategy. You can look at that and fix it for you. So if you're interested in making your money work for you, or your trade work for you, we can fix it. We can fix your strategy. Your strategy is not working, we can fix that. So after 3 months, if you do everything and you're still not profitable, we will refund your money. That's number one. Second way to give it to you for free is after you purchase it, if it works for you and you give us a testimony, you give us some kind of a feedback, you tell us that yes, it did work for you and here is how it worked for me. And you give this to us, we want to share that with other traders, and we will refund your money as a thank you. If you show us that it worked for you, you will get it for free. Just show it to us, show us your documentation, share your testimony with us so other people can see that it actually works, and we'll give it to you for free. The third way to get it for free is join our professional traders. If you decide to become a funded trader, if this worked for you, and of course it's going to work for you, and you decided to use our money, to use our capital to trade the market, and we go into an agreement where we do a split, a split profit. Maybe 95% to you, only 5% to us, and we're gonna give you, let's say, $100,000, $200,000, depends on what your risk tolerance is, okay, and what your risk deposit is. If we give you that, if you become a funded trader, the first $300 is gonna come out of, you are not taking any percentage from your account unless you take all that $300 for your trading plan. So what I'm giving it to you here, I'm gonna give it to you for free, as long as you do what you're asked to do. If you execute that trading plan the way it's supposed to, and it doesn't work, you're gonna get your money back. If it works and you provide a testimony, you're gonna give your money back. If it works and you start using our money to trade our own account, and we split the profit 95% to you and 5% to us, you're gonna get your money back. There is no risk to you. I'm not sure if there's anybody else is doing that in this particular industry. Most traders, most mentors, they just want to take your money and run. They don't offer you anything because they cannot promise you anything. They just showing you things that they read in a book or things that necessarily doesn't work. One strategy without anything else is just not going to work. Doesn't matter how much they give you, how they tell you, it's just not going to work. You have to have the full picture of how it works, and you have to have a trading plan. If you have any questions, please let us know. You can email us at daytradingfans@gmail.com. You can download our app on your Android or Apple. Just scan the QR code and it's going to take you straight to the download page and download. This is the best way to talk to us, chat with other traders. You don't have to buy anything to chat with other traders. Everything is transparent. We're trying to be transparent with you. So download the app and you can either purchase your trading plan. You can go to the website and purchase your trading plan. Just make sure you add that 70, the number 70 into a coupon. Apply that coupon. It's going to take $700 off that trading plan. Or join us. You don't have to buy anything to join us. You can join us on the website, you can join us on the app, you can join us on Facebook, you can join us on YouTube, you can join us on Udemy. There is a million ways to join us. We are not just offering you a course, just like most people do. We are not offering you one strategy that's going to make you millions of dollars and you know it never works. We are offering you a community. We are offering you to be part of the family. We are offering you your money back if things doesn't work. I cannot be more transparent than that. We want you in the team. And here's another thing. At this time, if you speak Indian or you speak Spanish, we would love to have you as a mentor. So we're going to teach you how to use the trading plan. We want you to translate for us, or at least to teach our Indian students and Spanish students, Hispanic students, the same thing. We are pretty much expanding to pretty much the entire world. And there's a huge demand coming from India for us. There's a lot of people come from South America, and we need help with Spanish-speaking mentors as well as Indian-speaking mentors. Please let me know if you're interested in that. Please send me an email. We can hire you, and hopefully you can become part of the team and become part of the family. For now, best of luck trading your stock market.